So South Africa's President Cyril Ramaphosa today issued a statement asking the country to shift towards recovery as the economy collapsed by half in the second quarter of the current year. The 51.0% GDP decline was worse than almost all the estimates, even the most bearish of 47.2% predicted in the Bloomberg survey. So where does South Africa go from here? And how? Let's chat to Chris Hart, an asset manager at Impact Investment Africa, based in Johannesburg. A good evening to you, sir. Good to see you again, Chris.
Yes, good evening.
It's good to have you. Thank you so much. I'm so glad you can still put some smile on your face despite the GDP reports we're having today.
No, it was grim reading. Basically every single sector of the economy actually declined, except for agriculture. So there was small declines, and the government sector was flat. Every single private sector, except for agriculture, was down. The agriculture sector not affected by the slowdown. Good rains and good crops has helped the sector, but in previous years that sector has struggled a little bit. But we're talking about at least 5 sectors that have got that went down by more than 2/3, 66% or more. More than 5 of the 9 sectors were there, and that actually really reflects a very, very weak position.
What sectors were the most hard hit in the second quarter?
It was basically construction, mining, and manufacturing, transport and communication, and trade. Those sectors were basically also most affected by the shutdown, but even the finance sector was a big decline of almost, around about 1/3. These are annualized figures, but we need to appreciate that the economy was weak beforehand. And what also took place in this quarter is that the actual government sector itself became the biggest sector in the economy, with the decline of the rest, and the actual government sector virtually flat for the quarter. And that, of course, is one of the internal weaknesses of the economy, is that you've actually got a big government sector that has to be sustained by that private sector. And you can appreciate with the rating agencies looking at the health of the overall debt and economic situation. This does not bode well for our credit rating. We probably will see further declines in the credit rating. And of course, we now need to see a very strong recovery in this. And South Africa needs to actually put itself on a more competitive footing. And I'm not sure if we're going to actually see the reforms that we need to actually get the economy on a more competitive footing.
What about financial services, in particular the banking sector, Chris?
Well, I think the first initial signs of the financial sector is that we're actually seeing a collapse of profits. First half profits in something like Absa, for instance, basically disappeared. Their profits were about down 97%. They were actually square for the quarter, and there we're going to see quite a lag as if the economy doesn't improve. We're going to see a stronger and stronger lag as consumers start to default on their debts and default on their debts for a longer period. And so if the economy does not pick up quickly, the financial services sector is going to see additional struggles. You can also see that in the actual stock market performance, where the financial sector has really struggled more than most in terms of the major sectors of the Johannesburg Stock Exchange. What sector has done exceptionally well is the gold sector. And we really have just a handful of gold shares left that's listed, but they really have been put through a stellar performance in the last 2-3 years as the rand has weakened and what's left of the sector has gone back into profitability with a higher dollar gold price. So the combination of the higher gold price and weaker currency has really, opened up margins there, and we can see it in the actual performance in the share prices as well.
So, in terms of the reactions to these GDP reports, what have you seen today from the business community? We understand that President Ramaphosa issued a statement saying this GDP is a call for everyone to make sure that the economy rebounds.
Well, I think, in a sense, a lot of the policy measures taken to deal with the coronavirus, and I say so-called pandemic, because the projections have not been as severe as expected, and I suspect that our policymakers were busy, concocting policy with a blind spot on the economy, and that blind spot is becoming very, very apparent at the moment. Clearly, there will be a recovery in the third quarter and fourth quarter as the restrictions are lifted. But I think where the government made a mistake is to actually keep restrictions on. They should have used the shutdown, to actually limit, the lockdown to a much shorter education period, so that people knew how to look after themselves with some, masks and hand washing, I think is good, but to actually return the economy as quickly as possible to normal, and people needed to consider that as, or that's the route I think we should have taken. Instead, we're getting this prolonged lockdown. The tourism sector, for instance, is still shut down, and this is now, more than half a year. And the tourist sector is a critical sector in terms of the services in restaurants, hotels, the air links that we have. All of these things are going to actually have a continued lingering effect in the economy. And these affect the multipliers. So when you see something not working in the hotel sector, you'll find that also affected in the manufacturing sector, like for the suppliers of that particular. And those are the things that need to be, that we have to watch out for in the next year or so. To what extent is the continued shutdown of some industries going to actually affect, and the multipliers are quite significant.
Chris, very quickly, the contraction in the South Africa's GDP or the economy has been 2 quarters into 2019. So before the coronavirus even emerged, the economy was already heading towards it was in negative territory. So what does that speak to about how the economy needs to rebound out of COVID-19, then back to pre-second quarter 2019 level?
Yeah, we're going to take a long time to get back to the levels. The economy not only was negative for the first 2 quarters of this year, it was also negative for the last 2 quarters of last year. So in other words, this is the 4th consecutive quarter of negative growth, and the sheer extent of the drawdown that we've seen this last quarter is unprecedented in the history of this particular data series, which started 60 years ago. And basically the economy had sunk into recession as a result of internal politics, the unattractiveness of South Africa as an investment destination because of overtaxation, overregulation, and rampant corruption. Those things are not being fixed. And then on top of that, we've got load shedding that's come across. And even with the economy in a subdued state, we're still seeing the electricity utilities struggle to actually meet demand with unscheduled breakdowns. And that, and even today we've had load shedding, despite the fact that the economy is in a subdued state. And that, of course, is a worry, because if the economy really was firing on all cylinders, we'd probably be, well beyond stage 4, stage 5 load shedding on any day. And that's the dangers. That's just electricity supply constraints is going to actually constrain our recovery. Besides the actual policy factors that we are not dealing with.
Thank you, Chris Hart, and we wish you folks all the best down there in South Africa. Thank you so much. Do have a great evening. Chris Hart, Asset Manager at Impact Investment Africa.